Now, Joe McAlinden's mantra could be Viva the V. He said that conventional wisdom has underplayed this recovery, and today's gains in consumer confidence as well as home prices only bolster his case for a robust growth that will come in the following months. Now, Joe is the chairman and portfolio manager at Catalpa Capital. Joe McAlinden, good to have you with us.
Good to be here.
All right, you've called one market rally. We give you a big check mark there.
Okay.
What's going on right now?
I think it's a little hiccup right now. I think that, as we talked about last time I was with you, there will be a significant correction in 2010, but I don't think we're there yet. I think the market's oversold short run right now. It's pulled back on a lot of confusing news. My guess is that it rallies from here another 10 or 15%, and the big correction comes when we move seriously in the U.S. toward a tightening of monetary policy and a withdrawal of the monetary stimulus.
Do you think that's really going to happen in 2010, let's say before the midterm elections? I
think it's going to, well, the consensus view is that it will happen late in the year, which positions it right around.
But you don't follow conventional wisdom.
I don't. And actually, my thoughts that I've shared with you before have been that as the economic, assuming we're right on the V, that as the economic growth continues to surprise on the upside, expectations of when the Fed will tighten will start to be telescoped more into the present, and possibly the market will start worrying about it in May, June, July. But I think what's going on in Washington right now raises the possibility that maybe the Fed doesn't tighten at all in 2010. They're going to be pummeled by all of this witch hunt stuff and finger pointing and threats of the Fed's independence. And unless the data is overwhelmingly robust, they may just sit tight.
But if you say we're going to get a V, I mean, is the economic data going to be so robust?
Well, Pimm, Friday we get GDP growth for the fourth quarter. Earlier in the year, I think one of the first times we were on the show last year, the consensus was around 1% growth. We look it up on Bloomberg for the fourth quarter. Now the consensus is 4.6. And I think that's going to be low. It could be over 5.
Over 5?
Yeah, it could. And in fact, it'll definitely be the highest growth rate in 3 or 4 years, and it might be the highest since the climb out from the bursting tech bubble in 02-03. There was a very strong quarter coming out of that recession.
All right, so if this is not the correction, how do you position the portfolio? What do you do?
I think you want to remain long here for an extension of the first up leg, which is what we're talking about, of this new bull market, and ride it until we get clear signs or a better sense of when the market's going to start really worrying about the U.S. Fed tightening. Now, other central banks have begun to move, and China's taken some steps, as we well know. But the Federal Reserve in the U.S. is still a long ways away from some serious tightening. Although we will see tomorrow, some new text from the Fed. And
going to be getting your magnifying glass out, right, along with the dictionary to kind of do that translation,
Everyone will, and be looking for some kind of hint. My guess is that if there is any hint of tightening, it will be very minimal. My best guess is that there'll be no change.
Best industry group right now to be invested in?
We've been positive on tech, and I still think tech is probably the strongest group for 2010, even though it did so well last year. It's just, it's just everything in our lives, and there's a huge global cycle going on right now.
What about the U.S. dollar? Does that stay strong?
I think the dollar has made a bottom for now and will probably be climbing through the year.
Climbing through the year. And what about unemployment? When do we get some kind of movement on unemployment?
That's the problem. I think the unemployment rate, is widely talked about. You need 100,000 new jobs created. We're still been losing jobs in the data up until now. 100,000 new jobs created just to stop the unemployment rate from rising. So I think it's going to be sticky on the high side, but it will drop below 10, but stay in the 8 to 10 range probably through most of next year, this year.
All right. I want to thank you very much. Joe McAlinden coming in from Catalpa Capital, sharing your insight. It's still a V.